Now, let's try to understand quickly what happens as a part of the taxation for the companies. Just like individuals pay income tax on their income, companies typically are liable to pay corporation tax, or in some cases, we also call it as corporate income tax or corporate tax. Different kinds of names, but that is paid on their taxable profit. This computation of taxable profit first will happen, and on that, depending on the slab levels of the company, depending on the tax rate that is applicable, the actual tax liability will be computed for the company. So first process is compute the taxable profit. To compute the taxable profits, two major elements come into picture. So we are talking about the profit that comes one from the regular business operations, which is the revenue minus the expenses coming purely from the operations part. That is included, as well as capital gains. What is for a capital gain for a company? Any kind of other income the company has got. Probably it has sold some asset at profit. Gain on sale of asset. Gain on sale of some investments. So all these are typically coming out as the income from the non-core business. But a taxable profit for a company will include both these things. So the typical way that we compute is, first of all, from the financial statement, we look at the income statement of the company, and within that income statement, we are taking the profit before tax. We are taking the profit before tax, and this profit before tax, we are trying to do a few adjustments. Now, to this, we might have used a few expenses in arriving at this. We might have used a few expenses wherein there is no allowance for tax. If there are any expenses which do not have any kind of allowances for tax, especially we are talking about fines for any kind of illegal activities. Let's say we are being fined. There is an expense for it, but there is no tax allowance for it. Means though I can show it in my income statement to arrive at my PBT, I cannot treat it as an exemption or an allowance from tax, which means that particular portion I have to add back. So those kind of expenses which are not allowed under tax, not allowable for tax. So those things I'm adding back. Along with that, whatever the depreciation that we have used to compute the profit before tax, even that we are adding back, but we are subtracting, in place of that we are subtracting what is called as allowable capital allowance. This is another name for depreciation which is used by the tax authorities, which means actually this regular depreciation is primarily targeted towards the financial reporting. Probably it has to be prepared in accordance with the international financial reporting standards or any other financial reporting mechanisms which the company is adhering to. But that is not the same case while they are filing for tax. The intention of this financial reporting is more of shareholders being and various stakeholders being the target. Whereas when it comes to actual tax payment, the way the capital assets are to be adjusted, the cost of the capital goods are to be adjusted, means the depreciation mechanisms differ between the financial reporting process and the tax reporting process. So whatever the tax reporting process is suggesting as a part of the depreciation of the capital goods, that is what comes out as allowance for allowable capital allowance. I mean allowable uh, allowable capital on the capital goods, whatever is the allowance that I can typically go for. And in case there is any kind of a special relief wherein there is a tax deductibility that is applicable, any kind of expenses which I might have spread over multiple years, but I will get the tax benefit immediately. Probably R&D expenses, research and development expenses. Normally in the financial statements, let's say I have incurred 100,000 towards R&D. And probably if I am believing that this is going to be giving me a 4-year useful life, then using the phenomenon of depreciation, I would have shown 25 as a part of the expense over 4 years. But from the tax perspective, I will get the tax deduction allowance or benefit of entire 100,000 in the first year only, not in the last 3 years. So this is where I am deducting those kind of special relief kind of stuff and finally arriving at that taxable profit, on the top of which, depending on the percentage that is applicable, the actual tax amount is computed, right? And now once the tax is computed, we are talking about the reliefs that are possible, especially to the shareholders. See, the company has made a payment for tax from the PBT. There is a tax that is paid, arriving at profit after tax, and this amount, part of it is distributed in the form of dividends to the shareholders. Now, now dividend goes as income to the shareholders. Now, in normal case, as per their income based slabs, they have to pay a tax on their income. But this is where some kind of a relief will come to the shareholders, that in case that particular dividend is subjected to corporate income tax, it will not be subjected to personal tax and vice versa. So that is called as an imputation system. So probably it's as good as like this. Probably let's say I have to get a share of $1,000 as a dividend. But for this $1,000, company has paid a corporate tax of 30%, which is 300. Let's say company has paid a corporate tax. Now, when I am receiving this $1,000 in the form of dividend, let's say my individual tax bracket is 20%. Means logically I have to pay a tax of only 200. But the company has already paid 300 on my behalf, which means I am eligible for a credit of $100. But if my tax bracket individual is 40%, then I am supposed to pay $400. But my company has paid only 300 here, which means I am liable to pay another 100. So this is a kind of an imputed system which is ensuring that there is no disadvantage to the shareholder when the company is distributing the profit. But what we see in some cases is the government really wants the companies to retain majority of the profits, so get new capital and probably expand. Now this is one more. How is this done? One way it is done is show a differential taxation. Probably tax the capital gains lesser, but tax the dividends more and more. So in this case, the shareholders may not be interested in receiving the dividends at all. They may be interested in the company doing more and more of a retention, expansion, and that could typically that kind of a relief, tax relief the government can give to the capital gain could result in more and more capital flowing in rather than more and more of a distribution, which can result even in the growth of the economy as well. So these kind of basic aspects regarding the corporate taxation we really need to be comfortable with. All right.